Imagine you wake up one morning and every bank account on the planet is wiped clean. Not hacked, not frozen, just gone. No dollars, no euros, no digital balances, anywhere. You walk to the grocery store with nothing but your skills and whatever you own, and you try to explain to the guy behind the counter that you'll fix his plumbing in exchange for a loaf of bread. He doesn't need plumbing fixed. He needs someone to watch his kids. You don't do that. So you leave. Hungry. That moment, that maddening, helpless moment, is where all of human economic history begins. And two guys named Marcus and Dave are about to live through the whole thing. Marcus is the kind of person who reads the terms and conditions. He's the one who pauses before making any decision, double-checks his math, and carries a small notebook in his back pocket for reasons he can never fully explain. Dave, on the other hand, is the person who once tried to pay for coffee with a gift card to a store that no longer existed, then argued with the barista for 4 minutes about whether the store's closure was technically his fault. Dave is enthusiastic. Dave is confident. Dave is almost always wrong at the most expensive possible moment. Together, these two somehow decided to travel through the major chapters of economic history as a hobby, which tells you everything you need to know about their respective life choices. Their journey starts in ancient Mesopotamia, roughly 5,000 years ago, and the first thing Dave announces when they arrive is that this is going to be easy. It's just trading stuff, he says. I have things, other people have things, we swap. Simple. Marcus opens his notebook. This is not going to be simple. The earliest human economies ran entirely on barter, the direct exchange of goods and services without any intermediate medium. If you grew wheat and needed pottery, you found a potter who needed wheat, and you swapped. On paper, this sounds beautifully straightforward. In practice, it created a problem so specific and so frustrating that economists gave it a formal name, the double coincidence of wants. For a barter trade to work, you needed to find someone who had exactly what you wanted and also wanted exactly what you had at the same moment in time. Miss either condition, and you were stuck. Dave, naturally, ignored this completely. He'd spent the morning collecting a large pile of fish, his logic being that everyone needs food, therefore fish were universally valuable. What Dave had not considered was that fish rot. He walked up to a farmer with a cart of grain and held up his fish proudly, announcing a trade. The farmer looked at the fish, then at the sun beating down overhead, then back at Dave. How long have you had those? Marcus, watching from a safe distance, quietly wrote the date and time in his notebook. Here's the thing about barter that most people get wrong. They assume ancient people were bad at economics because they used barter. Actually, the opposite is true. Ancient communities were extremely sophisticated about trade, they just had to be, because barter only works within small, close-knit communities where everyone knows each other. Transaction needs are relatively limited, and goods are traded quickly. The moment communities grew larger and more complex, barter started breaking down. The fish problem wasn't Dave being dumb. The fish problem was civilization outgrowing its original financial system. Dave eventually traded what was left of his fish for a single ceramic cup, which he felt was a solid win. Marcus pointed out that he'd spent an entire day doing it, and the cup had a chip in it. They agreed to disagree. The solution that emerged across ancient cultures, and it's remarkable how independently this happened in places as distant as China, Mesopotamia, and pre-Columbian America, was to find a commodity that nearly everyone valued, that didn't rot, that was easy to carry, and that could be divided into smaller units. The first forms of this kind of commodity money included things like grain, salt, and shells. Salt was so valuable in parts of Africa and Asia that Roman soldiers were supposedly paid in it, which is where we get the word salary. And yes, that means being worth your salt is a genuine historical compliment, not just a phrase your grandparent uses. Marcus explained all of this as they walked into the next chapter of their journey, ancient grain markets in early Egypt. Dave listened for approximately 30 seconds before spotting a merchant and immediately trying to trade his chipped ceramic cup for a bag of figs. The merchant looked confused. The cup was not a recognized unit of exchange. It was just a cup, a chipped one. You need something everyone agrees has value, Marcus said. That's the whole point. Individual objects don't work. You need a shared standard. Dave looked at the cup, then at Marcus, then back at the merchant. What if I told him it was a special cup? He would not believe you. This is actually one of the most important insights in all of monetary theory, and it took thousands of years and a lot of chipped cups for humanity to fully grasp it. Money only works because everyone agrees it works. This shared belief, economists call it trust or credibility, is what separates money from just another object. A seashell is only currency if your trading partner also believes it's currency. The moment that shared belief breaks down, you're holding a seashell again. This principle, which sounds almost philosophical, turns out to drive everything from hyperinflation in Weimar Germany to the collapse of cryptocurrency exchanges in the modern era. More on that later. The next major leap happened when civilizations in Lydia, a kingdom in what is now Western Turkey, began minting standardized coins around 600 BCE. The Lydians were the first to produce coins of guaranteed weight and purity, stamped with the authority of the king. This was genuinely revolutionary. Instead of weighing out lumps of metal every time you wanted to buy something and arguing about whether your gold was pure, you now had a coin with the government's word stamped right on it. It was portable, durable, divisible, and universally recognized within the kingdom. Dave was thrilled. Now we're talking, he said, jingling a handful of coins with obvious satisfaction. This is money. Real money. I understand this. 2. Marcus asked where he'd gotten the coins. Dave said he'd traded the cup. Marcus said that was actually impressive. Dave said it turned out he really was a good trader, and maybe Marcus had been too negative. What happened next was not impressive. Dave, excited by his new coins, immediately approached a money changer near the marketplace and attempted to convert his Lydian electrum coins, a natural alloy of gold and silver, into pure gold coins because he'd heard pure gold was worth more. The money changer quoted him an exchange rate. Dave agreed without doing the math. He ended up with fewer coins than he started with, and, crucially, not enough to buy the lamp he'd wanted. He stood outside the lamp shop with his remaining coins, doing arithmetic on his fingers, and arrived at the correct conclusion approximately 10 minutes too late. This is where things get interesting economically, because what Dave ran into was one of the oldest persistent problems in monetary history: currency debasement and exchange rate manipulation. As coins spread across the ancient world, rulers discovered something tempting. If you were in charge of minting coins, you could quietly reduce the amount of precious metal in each coin while keeping the face value the same. Spend less gold per coin, produce more coins, pocket the difference. It seemed like free money, and in the short term, it was. In the long term, it destroyed trust in the currency. Merchants and traders who handled coins constantly eventually figured out what was happening. They'd test coins, weigh them, scratch them to check the metal beneath the surface. Rumors spread. People demanded more coins for the same goods. Prices rose. The currency lost its purchasing power. This process, officially called debasement, though most ordinary people at the time probably used considerably less polite terms, played out repeatedly across empires. The Roman denarius started as a nearly pure silver coin and ended up, centuries later, as a bronze coin with a thin silver wash that wore off embarrassingly fast. Historians believe this currency debasement was a contributing factor to the economic instability that helped unravel the Roman Empire. Dave, upon hearing this explanation, nodded seriously and said, "So basically the whole empire fell because someone was too cheap with the silver." "That is an extremely simplified version," Marcus said. "But not wrong?" "Not entirely wrong, no." They moved forward in time, arriving in medieval Europe, where a new financial technology was emerging that would change everything: banking, and more specifically, paper money. Marcus was excited about this. Dave was suspicious. The story of paper money is, at its core, a story about trust and convenience battling each other. In medieval Europe, merchants who needed to move large amounts of gold across dangerous roads came up with a clever solution. Instead of carrying the gold, they'd deposit it with a trusted goldsmith in one city, receive a written receipt, travel to the next city, and hand that receipt to another goldsmith who was part of the same network. The second goldsmith would hand over gold in exchange for the receipt. The receipt had effectively traveled instead of the gold. It was lighter, easier to hide, and far less likely to attract thieves. These receipts evolved into banknotes. People started trading the receipts directly, without ever bothering to collect the gold. After all, as long as you trusted the goldsmith's network, the paper was as good as gold. And here was the first crack in the system. Goldsmiths realized that not everyone came to collect their gold at the same time. Usually only a fraction of depositors wanted their gold on any given day, which meant the goldsmith could lend out some of the gold that was sitting in the vault, charge interest on those loans, and earn money from gold they didn't technically own. This is called fractional reserve banking, and it is either a brilliant mechanism for economic growth or a house of cards, depending on which financial commentator you're reading. Dave, upon learning this, immediately tried to open a banking business with the one coin he had left. "I'll hold people's stuff," he announced, "and then lend it to other people." Marcus asked what he would do if multiple people wanted their stuff back at the same time. Dave paused. "I'd explain that I was busy." Marcus wrote something in his notebook. It may have been the word "no." What Marcus was getting at is the fundamental vulnerability of fractional reserve banking, the bank run. If depositors lose confidence in a bank for any reason, rational or not, and they all try to withdraw their money simultaneously, the bank simply cannot pay everyone. It doesn't have enough. The gold, or the cash, is out on loan. When this happens, panic spreads to other banks, people rush to withdraw everywhere, and the entire system can seize up in what economists call a financial panic. This happened with terrifying regularity throughout the 19th century, roughly every decade, culminating in the bank panics of 1893 and 1907 that eventually pressured the United States into creating the Federal Reserve in 1913. The Federal Reserve, often called simply the Fed, is one of the most powerful and least understood institutions in modern economics. It is the central bank of the United States, and it controls the supply of money, sets key interest rates, and acts as a lender of last resort when banks get into trouble. The creation of the Fed was supposed to end financial panics. It did not end financial panics, but it did change their character substantially, which is either progress or a cautionary tale depending on your philosophy. Marcus and Dave arrived in 1929 just in time for the Wall Street crash, which Dave immediately tried to time the market on. He bought stocks on the way down, convinced each drop was the bottom. He was wrong 6 times before Marcus physically removed him from the vicinity of any financial instrument. The Great Depression that followed the 1929 crash revealed something profound about the nature of modern economies. They run on confidence as much as they run on goods and services. Banks failed, unemployment soared to 25%, and people who did have savings often buried them in the backyard rather than trust any institution with them. The economic debate about what caused the Depression and what ended it has never fully resolved. Keynesian economists argue that government spending pulled the country out, while monetarists like Milton Friedman contend that the Federal Reserve's catastrophic decision to tighten the money supply during a contraction made a recession into a catastrophe. What both camps agree on is that the gold standard, the system in which every dollar was backed by a fixed amount of gold held in reserve, severely limited the government's ability to respond. If you couldn't print more money without having gold to back it, and you couldn't get gold, you couldn't expand the money supply even when contraction was killing the economy. Franklin Roosevelt ended the domestic gold standard in 1933. The international gold standard survived in a modified form until 1971, when Richard Nixon announced that the United States would no longer convert dollars to gold at a fixed rate, in what became known as the Nixon shock. Dave, when told that the dollar was no longer backed by gold, spent several minutes asking what it was backed by instead. Marcus said, essentially, the full faith and credit of the United States government, plus the collective belief of the global economy that dollars were valuable and would remain so. Dave said that sounded like the Shell thing all over again. Marcus said it was exactly like the Shell thing, but with aircraft carriers and treasury bonds. Dave needed a moment to sit with that. The post-1971 world is what economists call a fiat currency system. Fiat is Latin for "let it be done," meaning the currency has value because the government declares it has value and because everyone agrees to act on that declaration. Fiat systems give governments tremendous flexibility. They can expand the money supply during a recession, contract it during inflation, and respond to crises in ways that gold standard economies simply cannot. The downside is equally large. Without the discipline imposed by a gold backing, governments can print money irresponsibly, leading to inflation or, in extreme cases, hyperinflation. The most famous example of hyperinflation remains Weimar Germany in the early 1920s. After World War I, Germany faced enormous reparation debts and responded by printing money to pay them. Prices rose. The government printed more, prices rose faster. The cycle accelerated until the currency became functionally worthless. Workers were paid twice a day because prices rose so fast between morning and afternoon that waiting until evening to spend your wages meant you could buy less. People famously needed wheelbarrows of cash to buy bread. The story of the Weimar hyperinflation is so extreme it almost sounds fictional, but every element of it is documented in excruciating detail by economists who studied it with a combination of horror and professional fascination. Dave asked what had stopped it. Marcus explained that Germany introduced an entirely new currency, the Rentenmark, backed by land and industrial assets, and that the hyperinflation stopped almost overnight once people believed in the new system. Dave said that sounded like a trick. Marcus said that was one way to describe it, and another way to describe it was a successful restoration of monetary credibility. Dave said those sounded like the same thing. Marcus admitted they kind of were. The second half of the 20th century brought an explosion of financial innovation that Marcus found genuinely thrilling and Dave found personally dangerous. Credit cards arrived in the 1950s. The first was the Diners Club card, issued in 1950 and accepted at 27 restaurants in New York. It operated on an entirely new principle. You spend now, you pay later, and the card company stands between you and the merchant handling the settlement. Dave immediately tried to get a credit card. Marcus asked if he understood how interest worked. Dave said he did. Marcus asked him to explain compound interest. Dave said it was when interest got bigger over time. Marcus asked by how much. Dave said more. Marcus put a hold on the credit card application. Compound interest is, depending on whether you're earning it or paying it, either the most powerful wealth-building tool in human history or the financial equivalent of quicksand. Albert Einstein may or may not have called it the eighth wonder of the world. The quote is disputed, but the math behind it is genuinely staggering. A single dollar invested at 7% annual interest, left completely alone, doubles roughly every 10 years. Over 50 years, that dollar becomes $32 without any additional investment. The inverse is equally true. A debt at high interest rates, left unpaid, grows in the same exponential pattern. Credit card interest rates in the modern era often run between 20 and 30% annually, which means that unpaid balance doubles in roughly 3 years. Dave, learning this, became very quiet and then asked Marcus if he could borrow some money. The global financial crisis of 2008 brought these dynamics into focus in the most dramatic way possible since the Great Depression. The crisis emerged from a chain of interconnected bad ideas that each seemed, in isolation, like clever financial engineering. Banks issued mortgages to people who couldn't afford them. Those mortgages were bundled into securities and sold to investors who didn't fully understand what they were buying. Rating agencies graded these securities as safe investments when they weren't. Insurance products were sold guaranteeing those securities against default. When the housing market started to decline and borrowers began defaulting, the whole structure collapsed simultaneously, and the losses cascaded through the global financial system with terrifying speed. Marcus and Dave arrived at a financial firm in Lower Manhattan in September 2008 and watched through a glass partition as traders stared at their screens with an expression that can only be described as structured disbelief. Dave asked what was happening. Marcus said that Lehman Brothers, one of the largest investment banks in America, had just filed for bankruptcy. Dave said that seemed bad. Marcus said it was the largest bankruptcy filing in American history up to that point, and that within hours, global credit markets would essentially freeze because no institution trusted any other institution enough to lend money. Overnight, Dave asked what that meant for regular people. Marcus said that if credit markets froze completely, companies couldn't make payroll, supply chains would collapse, and the unemployment rate could reach Great Depression levels within months. Dave said that seemed really bad. Marcus said yes. What followed was a massive and controversial government intervention, bailouts, stimulus packages, quantitative easing that stabilized the system but left behind lasting resentment about who bore the costs. Banks were rescued. Most of the executives whose decisions caused the crisis kept their jobs and bonuses. Millions of ordinary people lost their homes, their savings, and their confidence in the entire financial architecture. From that wreckage grew several things: a reform movement, a populist anger that shaped politics for a decade, and, in January 2009, a white paper published under the pseudonym Satoshi Nakamoto describing a new kind of currency called Bitcoin. Bitcoin was, in its original conception, a direct response to everything that had just happened. Its creator, whose real identity remains unknown to this day, proposed a currency that existed outside any government or banking system, was governed by mathematics rather than institutions, had a fixed maximum supply of 21 million coins, and allowed people to transact directly with each other without any intermediary. Where traditional currencies required trust in governments and banks, Bitcoin required only trust in cryptography and code. Dave, predictably, bought Bitcoin at what turned out to be the exact wrong moment. He did this twice. He refused to discuss the details but confirmed that one of the times involved something he referred to only as the pizza incident, which Marcus interpreted to mean he had sold Bitcoin to buy food at a moment when the value subsequently increased dramatically, which is in fact exactly how most early Bitcoin adopters describe their relationship with the currency. The fundamental questions raised by cryptocurrency have not been resolved. Is it money? Is it an asset? Is it both? Is it neither? The answers depend substantially on which of the functions of money you prioritize. Economists traditionally define money as serving three functions: a medium of exchange, a store of value, and a unit of account. Traditional currencies do all three moderately well. Bitcoin's performance varies dramatically depending on which year you check. In years when its value quadruples, it's an extraordinary store of value. In years when it drops 80%, it fails that test catastrophically. As a unit of account, it remains limited because almost no one prices goods in Bitcoin. As a medium of exchange, it works technically, but the infrastructure remains complex for everyday use. What Bitcoin and the broader cryptocurrency movement did accomplish, regardless of where the technology ultimately goes, is force a conversation about the fundamental nature of money that most people had never had. It asked, explicitly and unavoidably, what does money actually do? Where does its value come from? Who controls it, and should they? These questions are not new. They're as old as the first clay tablets recording grain debts in Mesopotamia, but they'd never been asked so publicly and urgently by so many people at once. Marcus and Dave found themselves sitting on a park bench in the present day, which felt like the appropriate place to land after 5,000 years of economic history. Marcus had filled 3 notebooks. Dave was looking at something on his phone. The arc of monetary history, when you step back far enough to see it whole, describes a consistent pattern. Every innovation in money expands what's economically possible, and every expansion creates new vulnerabilities. Barter gave way to commodity money because it was more efficient, but commodity money was bulky and scarce. Coins solved that, but enabled debasement. Paper money solved portability, but enabled inflation. Credit solved liquidity, but enabled debt spirals. Digital money solved frictionless transactions, but created new forms of fraud and systemic risk. At every stage, the new system worked better than the old one in some crucial ways and worse in others. What runs through all of it, the grain receipts, the silver coins, the Federal Reserve notes, the blockchain ledger entries, is the same thing that always ran through it: belief. Shared, collective, sometimes fragile belief that this thing, whatever form it takes, means something. That it can be exchanged for what you need. That the person you give it to today will find someone else who accepts it tomorrow. Money is, at bottom, a social technology. It doesn't exist in nature, it exists in agreements. Dave looked up from his phone. He'd been watching the price of a cryptocurrency fluctuate in real time. It had gone up 17% in the last hour and then immediately dropped 23%. He stared at the chart with the expression of a man who has learned something important but cannot quite articulate what. So all money, he said slowly, is just people agreeing. Yes, said Marcus. And if people stop agreeing, it stops being money. Dave thought about this for a long moment. Then he looked at the coin he still had in his pocket, the Lydian Electrum coin he'd somehow kept through 5,000 years of economic history, probably because he'd forgotten it was there. He looked at it for a long time. Huh, he said. Marcus was already opening his fourth notebook. There was still the entire history of taxation to cover, and he had a feeling Dave was going to try to argue his way out of it.